I welcome you to the Aleph Consult platform once again. So today's session will be on Islamic accounting, particularly Sukuk accounting. In the previous session, we'll look at the meaning of Sukuk accounting, the parties that involve in the Sukuk accounting transactions, and then how to treat Sukuk accounting under International Financial Reporting Standard, and then Accounting and Auditing Organization for Islamic Financial Institutions. So today's session will be a practical-based session. We are going to solve practical questions under both IFRS and then AAOIFI. And I read the question. The statement of financial position of Aleph Enterprise for the year ended December 31st, 2008 is as follows. Assets, we have building 100 million, cash 50 million. Financed by aspect, we have share capital of 120 million, retained earnings of 30 million. AE, that's the Aleph Enterprise, need 100 million to finance its activities and want to raise funds through issuing Sukuk Ijara. On January 1st, 2019, AE set up a special purpose vehicle and sell its office building to the SPV, that's a special purpose vehicle, for 100 million. The SPV then issued the 100 million Sukuk to investor, that's the Sukuk holders, and hold the office building in trust for Sukuk holders. AE agreed to buy back the office building at 110 million on December 31st, 2003. The SPV leases the office building to AE for 5 million annually. AE makes a profit of 40 million each year. Let's assume that all transactions are on cash basis. And then the internal rate of return on the loan is about 6.7477%. You are required to account for Sukuk accounting under International Financial Reporting Standard in the books of the originator, that's AE. And then the second requirement is account for Sukuk under Accounting and Auditing Organization for Islamic Financial Institutions in the books of the originator. So we start with International Financial Reporting Standard. So as I explained in the previous session, for under the International Financial Reporting Accounting Standard, the originator will be paying financial cost to the Sukuk holder. And then we have been given the internal rate of return, which is 6.7477%. 6.7477%. So it means that every year the originator will be paying this amount on the Sukuk amount, or the amount of money that the investor gave to the originator. So as I explained earlier, the originator will recognize this amount as finance cost. So we prepare a schedule for the finance cost. So that's if we finance cost for 5 years. Now we create a column for year. The transaction took place 2019. So first year will be 2019, second year will be 2020, third year will be 2021, fourth year will be 2022, and then fifth year will be 2025. And we will create a column for Sukuk liability. Sukuk liability. And then the finance expense itself. So finance expense. And then the next column will be the cash paid. Since it was stated that the SPV leases the asset to the originator at 5 million annually. So that will be the cash that they will be paying. So cash paid. And then the last column will be the Sukuk liability, that's the closing balance. So Sukuk liability, and that will balance carried down. And then over here will be the balance brought forward, that's the opening balance. Okay, so the actual amount of money that the Sukuk holder, that the investor gave to the originator was 100 million. 100 million. So it means at the beginning of 2019, the originator is having a liability of 100 million. But from the question, the internal rate of return, that's the amount of interest that the originator will be paying to the was given to us as 6.747%. So since at the beginning of the year, the originator is showing an amount of 100 million. So you find 6.77% on the 100 million, and then that will be the finance cost that the originator will be paying. So if you find 6.7477 on 100 million, you get an amount of 6.75. That's when you run it to the 2 decimal place. And then in the question, we were told that the SPV leases the office building back to the originator for annual cost of 5 million. So it means that every year they will be paying 5 million. So 2019 they will pay 5 million, 25 million, 21 5 million, 22 5 million, and then 25 to 5 million. But there is the finance charge, but they are paying only 5 million. So it means that they will be owing additional 1.75 million. That's the difference between the finance expense, which is 6.75, and then the amount of money that they pay, which is 5. So the difference will be 1.75. And then at the beginning of the year, they are owing 100 million. So it means at the end of the accounting year for 2019, the Sukuk liability, that's the total amount that the originator will be owing, will be the initial amount plus the difference between the finance expenses and then the cash paid, which is 1.75. So the Sukuk holder will be owing 101.75 at the end of the first year. And then this 101.75 will become open balance for the second year. So at the beginning of 2020, this is the amount that the originator will be owing the Sukuk investor, 101.75. And then since this is the amount that the originator is owing the Sukuk holder, and then annual rate or the finance expense rate is 6.7477. We find 6.7477 on this amount. That will be the finance expense for the year. And then if you find the percentage on the 101.75, you get 6.87. 6.87. And then again they paid only 5 million. So you find the difference between 6.87 and then 5 million, you get 1.87. And then you add 1.87 to the amount of money that they are owning at the beginning of 2020. And then this will give us 103.60. 103.60. Okay. So this is the closing balance or closing liability after 2020. And then this amount will serve as an open balance for 2021. So for 2021, at the beginning of 2021, the amount that the originator is owing the Sukuk holder will be 103.62. And then this amount, we apply the finance expense rate on this, and then you will get 6.99. You get 6.99. And then you subtract the cash amount of cash that they paid, which is 5. So 6.99 minus 5 will give us 1.99. And then you add this 1.99 to 103.62. and it will give us 105.61. 105.61. So this amount will serve as the open balance for 2022. 105.61. So over here too, you will apply the finance expense rate on this, and then you will get 7.13, and then you deduct the cash payment of 5 million from this, and you get 2.13, and then you add this 2.13 to the amount of money that you are owing at the beginning of 2022. Then this will give us 107.74. 107.74. And then this 107.74 will serve as the open balance for 2025. Okay. So on 2025 too, we will apply the rate, that's the finance expense rate, on the amount that the party is owing at the beginning of 2025. And then if you apply the rate on this, you will get 7.26. So you deduct the 5 million cash payment that they made from this, and then the difference will be 2.26. So you add this 2.26 to the 107.74, and then to give us 1110. So if you refer back to the question, the originator promised to repurchase the office building at the price of 110 million. So at the end of the 5 years, the amount of money that the originator will be owing the Sukuk holder will be equivalent to the amount that they promised to repurchase the asset, which is 110 million. Okay, so after you are done preparing the finance cost schedule for the 5 years, the next will be the journal entries. So the next will be the journal entries. Journal entries. See, for journal, we have date, we have particulars, and we have column for debit and credit. Okay, on the first January 2019, the originator sold the office vehicle to the special purpose vehicle for an amount of 5 million through Sukuk accounting, and then the Sukuk will serve as a liability to the originator. So this is how we record this transaction. So the date is January 1st, 2019. So after the disposal of the office building, the originator will receive cash in return for that, and then the disposal of the vehicle, or the amount the originator is receiving the 1 million from Sukuk. That's the liability. So the double entry will debit the cash account and then credit Sukuk account. Since the originator is receiving money, you are debiting cash, and then you are crediting the source where the originator is receiving money from. So in this scenario, the originator is receiving money through Sukuk or from Sukuk. So cash, and then Sukuk, and then the amount is 100 million. 100 million. And then narration will be the amount of financing raised through Sukuk. So amount of financing raised through Sukuk. So the next transaction will be the interest that the originator will be paying at the end of the accounting year. And then the originator will be paying the interest at the end of the accounting, which is 31st December 2019. 31st December 2019. And then this transaction will be affecting player account. So for 2019, the originator is entitled to pay a finance expense of 6.75, but he paid only 5. So first, you debit the finance expenses account and then credit your cash account. And after that, since the difference between the 6.75 and then the 5 million cash that the originator paid, increase the liability, increase the amount of money that the originator is owing the Sukuk holder. That's the liability. So you add the difference, which is 1.75 to the Sukuk amount. So the double entry will be you debit finance expense account and then credit your cash account and then credit a Sukuk account as well. Okay. So finance expense 6.75. Since they are paying cash of 5 million, their cash balance will reduce. So you credit your cash account. And then Sukuk is supposed to pay 6.75, but they paid only 5. So the difference will increase the amount of money that the originator is owing, or the difference will increase the Sukuk liability, which is 1.75. And then the narration will be finance expense for the period.
Or for the year. Okay, so the next will be the second year transaction, that's the 2022. So over here too, they will pay the finance expense at the end of the accounting year, which is 2020. Okay, so we use the same approach. Finance expense. And then finance expense for the 2022 is 6.87. 6.87. And then they paid cash of 5 million. So their cash balance will reduce. So we credit cash. So we credit cash. And then the difference will be added to the Sukuk balance. So we credit Sukuk account. The difference between this and this will give us 1.87. Then the narration will be finance expense for the year. So we continue with the third year, which is 31st December 2021. So over here, we call the finance expense. And then the finance expense for 2021 is 6.99. So you call 6.99. And then they made cash payments of 5 million. This will reduce their cash balance. So cash 5. And then the difference between the two will give us 1.99. And then we credit this to accounts. And then that's on the finance expense for the year. The next will be the fourth year, December 31st, 2020. Okay, so December 31st, 2022, the finance expense is 7.13. So, finance expense 7.13. And credit to cash account, don't be making cash payments. And then the difference will be credited to the Sukuk account. And then you write your narration as finance expense for the year. Then the fifth year, that's 31st December 2023. Over here, the finance expense is 7.26. So finance expense That's 7.26. And you credit your cash 5 million. And then the difference of 2.26 will be credited to Sukuk account. After that, we will write your narration. And then on the same 31st December, on the same 31st December 2023, the originator promised to repurchase the assets, that's the office building, at price of 110. So since the originator is buying back the assets, the originator will be paying cash. The originator will be paying cash of 110. So we will credit the cash account of the originator. And then since the originator is buying back the Sukuk or paying the amount of liability that the originator is owing the Sukuk investor or the Sukuk holder, this will cancel off the Sukuk liability. And we all know that for liabilities, they have a credit balance. So whenever you want to cancel it or reduce your liability, you debit it. So the double entry will be you will debit Sukuk, then credit cash. December 25th, 2010, that 110, and then credit cash 110. After that, you write your narration as redemption of Sukuk. So, redemption of Sukuk. Okay, so we are done preparing the journal entries under International Financial Reporting Standard. So the next will be the preparation of the income statement. So the next will be the preparation of the income statement under International Financial Reporting Standard. Okay. So we have for A, that's a Aleph Enterprise. So over here, because we are come to prepare the income statement, for 5 years, there is no need for us to write income statements for the year ended maybe 31st December 2019 or 2020. So you create a column for year ended as 31st December. After that, we will write the respective years. First year is 2020, 2019, second year 2020, third year 2021, fourth year 2022, and then the fifth year will be 2023. Okay, so the next column will be the operating income. So after getting your operating income, we deduct the finance expense. Finance expense. And then the difference between the finance expense and an operating income will give us the net income or the net profit. Net. And then from the question, it has been stated that AE makes a profit of 40 million each year, assuming all transactions are on cash basis. So it means every year we are making profit of 40 million. So the 40 million, every year they are making the same profit of 40 million. So the 40 million will be waiting for all the respective 5 years. And then less finance lease. So the finance is we'll be getting from the finance expense schedule that we made. So if you can recall from the finance expense schedule, remember that for the first year, the finance expense was 6.75. And then the second year was 6.87. And then the third year was 6.99. 6.99. And then the fourth year was 7.13. 7.13. And then the fifth year was 7.26. So the difference between the operating income, that's the profits, and then the finance expense, will give us the net income for the year. So for 2019, 40 minus 6.75 will give us 33.25. 33.25. And then over here for the second year, that's 2020 will give us 33.1. 33.1. And then for 2021, it will give us 33.01. And then for the fourth year, it will give us 32.87. 32.87. And then for the last year, the difference between these two figures will be at 32.74. 32.74. So this is how the income statement will be. So the last thing that we are coming to do under International Financial Reporting Standard is the statement of financial position. That's the balance sheet statement. So we are going to prepare the balance sheet statements for AAOIFI Enterprise. Okay, so we start with the license statement of financial position. Okay, so for this one, we are going to prepare for 5 years. So there is no need for us to write statement of financial position as at this, since we are coming to prepare for 5 years. So we have a borrowing for as at 31st December. And then we will create a borrowing for all the 5 years. So we have 2019, 2020, 2021, 2022, and 2023. Okay, so after creating the column for the years, we start with the assets. So for the assets in the question, they give us a building and then cash. So we create a column for building. And cash. So these are the only assets that organization have. Okay, so summation of the building and then the cash will give us their total assets. The column for total assets. After that, we proceed the finance by aspect. So finance by. So in the income statement, the organization we're having a share capital. We were having a share capital and then retained earnings. So we have share capital and then retain earnings. Okay, so we start with the asset aspect. So although the originator gave out or sold out the assets to the special purpose vehicle, but as I explained earlier, when it comes to International Financial Reporting Standard, they use substance over form principle. So because of this principle, they will still recognize the assets in the books of their financial statements. So we still recognize the 100 million. So the asset is 100 million. And then in the question, the organization was having a cash balance. That's the open cash balance of 50 million. And then the organization took a loan. That's a Sukuk of 100 million. And then since they are receiving loan of 100 million, this will increase their cash balance. So 150 million plus. And also, the organization made profits of 40 million. And then from the question, it was stated that let us assume that all the transaction was on cash basis. So it means that all the 40 million were used. So plus 40. So plus 40. After that, after the 40, the organization make a cash payment of 5 million. Although the finance expenses for the years were 6 points, for the first year was 6.75, but they paid only 5 million. So since they are paying 5 million, we deduct the 5 million from their cash balance, so minus 5. And then this will give us 50 plus 100 plus 40 will give us 190 minus 5 will give us 185. So the cash balance for the first year is 185. And then for the second year, we are having so this 185 will serve as an open balance for 2020. That's the second year. And then for the second year too, they made a profit of 40 million. And then they made payments of 5 million. So 185 plus 40 will give us 225. And then 225 minus 5 will give us 220. So 220 for the second year. 220 for the second year. And then this 220 will serve as an open cash balance for the third year, which is 2021. And then for 2021, they made profit of 40 million. And then they made a cash payment of 5 million, so minus 5. So this will give us 260 minus 5, that's 255. Over here, we have 255. And then this will serve as an open balance for the fourth year. And then for the fourth year, we made profits of 40 million, and then we made cash payments of 5 million, so minus 5. And this will give us 290. This will give us a balance of 290. So 290. And then this 290 will serve as 290 will serve as an open balance for the fifth year. Then they made profits of 40 million. And then they made cash payments of 5 million. And also don't forget that at the end of the 5 year, the originator repurchased the assets at a price of 110. So it means they are making cash payments of 110. So we deduct the 110 minus 110. And then this will give us a cash balance of 215. 215. 215. So the assets plus the cash will give us a total assets. 285, 320, 355, 390, and then 315. So we proceed with the finance by aspect. So the share capital has been given to us in the question as 120. And then this will go through us. Over here we have 120, 120, 120, and then 120. So in the question, the share capital has been given to us as 120. So this 120 for the previous years, we will be calling the share capital as 120. And then next will be the retained earnings. So for the retained earnings, it has been given to us as 30. So the organization will have a retained earnings of 8 and 30. the organization will have a retained earnings of 30. And then retained earnings too, we know that retained earnings is a part of profit that the organization didn't distribute it as a dividend to its shareholders, and then they keep that money at the retained earnings account or the income surplus account. And then since it was having an open balance of 30, and then every year the organization were making a profit of 40,000. So wasn't it that the organization were paying a dividend, but rather they were paying or they were charging a finance expense of 6.75, 6.87. So it means there's the net income that organization had. So every year we'll be adding the net income that we had to the retained earnings open balance. So for the first year, they will have an open balance of 30, and then they made net income of 33.25. So we add the 33.25 to the retained earnings open balance. Then that will give us 63.25. So that will be the retained earnings balance for the first year. Retained earnings balance for the first year, which is 6325. And then this 6325 will serve as an open balance for the second year. This will serve as an open balance for the second year. So for the second year too, we made a net income of 33.1. So you add 33.1 to this. And then and this will give us 96.38. 96.38. 96.38. And then this 96.38 will serve as an open balance. Will serve as an open balance for the third year. And then for the third year, we made a net income of 33.1 plus 33.01. So this project will give us a balance of 129.39. 129.39. So for the third year, 129.39. And then this will serve as an open balance for the fourth year. 129.39 plus the fourth year, the net income was 32.87. So this project will give us 162.26. 162.26. And then that will be the retained earning balance for the fourth year. And then this balance will serve as an open balance for the last year. And then for the last year too, they made a net income of 32.74. 32.74. So if you add up the two figures, it will give us 195. 195. So retained earnings balance for the fifth year is 195. So we are done recording the share capital and the retained earnings assets. So we will continue with the liabilities. That is Sukuk. So Sukuk. So the Sukuk will serve as a liability to the organization. Don't forget that in the conventional accounts, when you are preparing financial statements, after you record the stated capital and then other surpluses, we record the long-term liabilities as well. So we are coming to report the Sukuk. So for Sukuk, you can get the Sukuk balances from the finance expenses schedule that will be prepared. So at the end of the first year, the organization were having a liability of 101.75. That is Sukuk closing balance for the first year. 101.75. And then for the second year, it was 103.62. 103.62. And then for the third year, it was 105.61. 105.61. And then for the fourth year, it was 107.74. 107.74. And then the fifth year will be dashed because from the question it was stated that, or there was an agreement between the originator and the special purpose creditor that at the end of the 5th year, they will repurchase the Sukuk bank or they will repurchase the asset back at a price of 1/10. So it means that they have made payments for the liability or they have redeemed the liability. So, but they are redeeming the Sukuk. So it means that there will not be any liability at the end of the 5th year. And then the summation of these figures will give us the total amount or the capital employed. And also these figures, the summation of these figures is supposed to be equivalent to the total assets. So if you sum out this and this, you get 285. Over here, you get 320. And then here to get 355. And then here to you get 390. Then for the last year, we get 315. So this is how we report the book accounts under International Financial Reporting Standard. Okay, so this is how you report financials under International Financial Reporting Standard. So in the next video, we will see how we'll be reporting these same transactions under Accounting and Auditing Organization for Islamic Financial Institutions. So see you in the next session.